Welcome to For the Record. I'm Eric Schatzker. Heading into the credit crisis, the last big bank you'd have expected to need government assistance was Wells Fargo. After all, this is a company that didn't make big trading bets with shareholders' money, that didn't offer pick-a-payment mortgages, that made a major acquisition once a decade. Yet here we are, and Wells Fargo still owes taxpayers $25 billion, long after other banks have returned their TARP funding. So I came here to San Francisco to ask CEO John Stumpf when he'll finally be able to shake the government monkey off his back.
Not anymore.
When we got the capital, it was meant to be temporary. It's a temporary investment. We understand that. And we are paying a 5% after-tax dividend on that money, plus there's warrants. So this is a very good investment by the U.S. taxpayer. Secondly, our company has made more than $500 billion of loans to date to help homeowners buy homes, refinance homes, small businesses to build their businesses out, hire people. So we're doing the exact thing that the government wants us to do, helping to stimulate the economy. And we will pay it back. But we're going to pay it back in a shareholder-friendly way. And those are the key words, shareholder-friendly. Could I go out and raise a bunch of capital today? Absolutely. We've proven we can do it. But we're now earning capital so quickly, organically, we don't want to dilute our existing shareholders.
That answers an important question, obviously, as well, that you will not go and dilute shareholders expressly for the purpose of just freeing yourself of the government shackles, so to speak.
If you put expressly, yes. I never say never, but never's a long time. But our point of view, and my point of view, is we work on behalf of our shareholders, and we're not interested in diluting them more than they've been diluted just to free ourselves from the government. If that's the express purpose, I don't want to do that.
But should we expect Wells Fargo to carry this for another 5 years?
We will pay it back in the future. It won't be, it'll be temporary as it's supposed to be. I don't want to give a date, but we're earning capital quickly, and every day we put more capital in our books gives us one day closer to paying it off.
Would you consider doing what Bank of America is considering, which is paying back part of it in order to meet a threshold at which you're no longer considered to be receiving extraordinary assistance?
Well, first of all, we're not in that category. We're not one of the extraordinary circumstances.
Not the B of A's or the Citigroups.
Correct. And so we're not in that position, and we will pay it back shortly. It'll be in concert with what the Fed and our company agrees to, and I'm confident of all the issues I'm dealing with, this one doesn't keep me up at night.
Oh, I'm not suggesting it does, but it keeps other people up at night. They want to know what shortly means.
I can't imagine people, if they're up for that reason, they probably should have some other problems, because we are making loans, we're paying the dividend. This is a very high return asset for the taxpayer, and it's not going to be a long-term event here.
Okay, one last question on this subject. Initially, it seemed as though any bank that received TARP funding would have to replace all of that capital before being able to return it to the government. It doesn't seem as though that's the case anymore. Is that your understanding from the Fed, that you wouldn't have to replace all $25 billion before returning it?
Others have returned it and not replaced all of it. Now, in our case, we've already raised $21.2 billion, give or take. So we've raised a lot of capital, and that's before you consider the stock that we issue for our benefits program.
How onerous a situation is it to have the government as an investor?
Well, if I had two choices, I would have it the way it used to be without having them an investor. But management really is responsible for this company. We have very good exchanges with our regulators, and so far it's not, had a negative effect on how we run the business.
We all know, I think it's fair to say, that Wells Fargo wasn't entirely happy about the TARP, the way that it was imposed, the way that the stress tests were conducted, reports of fist-pounding, the use of some choice adjectives, shall we say. Looking back, how would you characterize that experience now?
Just think of what happened at the time. We had an economic downturn. In its wake, major companies with years and years of history were failing. Others needed support. So when it came right down to it, we're Americans first, we're bankers second. And if this was a way to bring confidence back, to remove the panic, so be it.
It's easy to look back, as you do now, and say, maybe they were doing the right thing and we benefited from it all. At the time, it didn't sound or feel that way.
Wells Fargo is 157 years old. We've always done, we believe, the right thing. We believed in capital. Our capital ratios were some of the highest in the industry. In fact, we were able to buy a company larger than ours, Wachovia, during this period of time without any help. We use our own money for that. So it's not unexpected to have a company with that kind of history, that kind of discipline, and that kind of views around capital to reject or at least look with some jaundiced eye over, bringing new capital in with the kind of way it's done. We never had preferred stock before as a matter of practice.
Would you agree now that it was necessary to add capital the way that it was added in the fall through an investment by the government? And subsequently, do you agree more or less, let's say, with the result of the stress test, that you needed more capital back in the spring?
No, I would not agree with that. We still believe we did not need capital at the time. We were able to go out and raise capital. The fact that we got capital from the government reduced the amount we could raise in the public markets. People are saying, well, why do you need more capital? Why do you need common stock? You just got $25 billion. So I think it reduced our ability to raise capital.
Encouraging signs of growth abound in the U.S. economy. There's even talk of a V-shaped recovery. But a recovery to what? John Stumpf has modest expectations.
If you use the Wall Street definition or the economist definition where it takes 2 consecutive quarters of negative GDP, yes, I agree that we'll likely have a third quarter of positive GDP. Would not surprise me if it'd be higher than what people are thinking right now, because autos might actually be a positive as opposed to a negative. Housing looks like it could at least be not a negative. So if you take that definition, I would concur. But if you go to Main Street, where we do business, there's not much talk about GDP. It's about jobs, and only about jobs. And in that case, we're long from out of this.
Well, as a banker, you know as well as anybody the conditions that created the growth that we had going into this crisis. Cast your eyes forward a year from now. How robust an economy do you think the United States will have?
Boy, every time I predict something, I wish I wouldn't have. So I won't predict this time. But I think...
I don't want you to put a number to it, but
well,
can we possibly recover what we had before?
Much of what we had before was an economy that was based on economics that were not sustainable. We were outliving our means. Families were outliving their means. Companies were outliving their means. Municipalities were outliving their means. States were outliving their means. The federal government was outliving its means. So if you're saying, can we go back to that? Absolutely not. You can't have a deficit wherever you are. Now we've gone from a spending nation to a savings nation all overnight, it seems. And to have savings rates that are record highs now, that I've not seen in a long, long time, is also probably not sustainable. So we'll see something in between. I think the big discussion today is, what will the recovery look like? Which letter of the alphabet? Will it be a W, a U, a V, or an L? Right. So it'll be one of those 4.
Does it not hurt in the short run a company like Wells Fargo to be so exposed to California, more so, say, than other banks of its size?
Yeah, but we're not exposed more so than what our deposit base is. So people say, well, you have 30% or something of legacy Wells Fargo of your loans here. Well, 30 or 35% of our deposits are here of legacy Wells Fargo. So in the new company, frankly, the new company actually gives us more diversity because the California business was not that large vis-a-vis other parts.
Does Wells Fargo not look at the American economy, the prospects for the American economy, and think maybe we'd like some exposure to some higher growth, perhaps at a slightly higher risk, overseas?
Our focus is on the U.S. 98, 9% of our revenues happen here. We have some international businesses, but they're predominantly used or in support of our U.S. customers. Our retail customers, our business customers doing business overseas. And we have some very nice businesses that do that. But if you think about it, the U.S. is the largest economy in the world. We have, with the merger of these two companies, the best footprint. And it's a footprint that we still are building out. And we have so much opportunity here in the U.S. It'll be for probably the next CEO to worry about the international business. We have so much to do right here.
Banks across the industry have had to raise non-performing assets, charge-offs, obviously. When do you think those peak? At what point are we at the top or bottom, depending how you look at it, of the credit cycle on that front?
Yeah. There are some indications that we're seeing a top in some of our problem loan areas. Everybody's talking about the next shoe could be commercial real estate, and commercial real estate covers so much. But there are some areas that we are at very high levels of loss, but they look like they're flattening out. So again, I can't give you a prediction. I don't know what's going to happen. It depends on probably things that are outside our control, like employment, as we just talked about. But we're at high rates now, and we're not seeing the level of increase in loss is very modest vis-a-vis what it was a few quarters ago.
Which businesses are you referring to specifically?
Auto, for example. Home equity seems to be, some of the early buckets seem to be maybe not getting worse than they were before. So credit card still seems to be a challenge, although we're not a national credit card bank. We tend to do it only for our own customers. So it depends on which category you're talking about. In fact, our loan portfolio, if I worry about anything, I worry about the shrinking size of our loan portfolio. I worry about finding good earning assets for the balance sheet. We started out at the beginning of the year at $864 billion of loans. We finished the second quarter at $821 billion. Now, some of that was purposeful. We want to get out of some of the deals, but we're also seeing the utilization rates of commercial loans lower than we've seen in a long time. As consumers and businesses are de-levering, it's coming out of loans.
Welcome back to For the Record. Put a bunch of bank CEOs in a room together, and it won't take them long to find common ground. When it comes to bank regulation, though, John Stumpf doesn't agree with his peers on Wall Street. They think the Fed should be the top dog. Here's Stumpf's view.
I'd have to ask the question, and I think it's an important one to ask, which regulator needed what regulation to cover something that should have been covered in the last few years? Which regulator didn't have the regulatory authority to stop what was going on? The answer is they all had it. And I'm not blaming the regulators. We all have plenty of blame here. There's blame to be shared by our industry. At Wells, we didn't do everything perfectly. We wish we would have. Consumers overextend themselves. But the things that I'm looking at is, will there be one regulator, or will we have a council of regulators? Will there be...
Do you have a preference?
I think the council makes a lot more sense.
Interesting. You disagree with some of your fellow CEOs on that front. There are a number of them.
We don't always agree on everything,
Well, no. Some of them have told me that it makes much more sense to have one single systemic regulator in the Fed. The Fed is the agency best able, best qualified to do that job. Yours is a different perspective at the very least.
I think that's a mistake. The dual banking system has served this country exceedingly well for 150 years or more. You have all different flavors and sizes of financial institutions. To have one place domicile with all that, I think you miss different points of view.
What about the argument that it just creates a patchwork of regulation, the kind that we had before? Things fall through the cracks, like mortgage origination, the explosive growth of CLOs, and the so-called distribution of risk to other countries, which really didn't insulate anybody from anything in the end.
Well, I'm not saying regulators shouldn't do their jobs. And I'm not saying the council wouldn't have a governance system around it. But I think you could get the benefit of a systemic regulator and also the benefit of differing points of view in the council. Why the tyranny of or? Why not the magic of and here?
Do you think career regulators in Washington can work together on that level? Because some people would raise some doubts as to whether these people, some of whom are ambitious, determined, want to make a name for themselves doing this, that, or the other thing, can actually see eye to eye with the guy running the other agency.
I think they can work together. Absolutely.
Systemic risk insurance. This is a proposal that's come up. The idea that big banks, more so big banks than the small banks, systemically important institutions should pay into a pool to protect the system from the kind of thing that we've just come through. You support that idea?
Well, again, I've not spent a lot of time on that, but let's just level the playing field here. If you look at the number of bank failures going on right now, it's actually in the smaller institutions.
A systemically important institution gets into trouble. How do you wind it down in such a way that it involves the minimum disruption?
There are companies and in institutions or parts of our industry, if you take financial services very broadly, that did not have that mechanism. There was no way to wind them down the way you do banks. Whether that should be resident within the FDIC or some other place, that's not in my job.
But it needs to be somewhere.
It needs to be somewhere, absolutely. But I almost don't view that as regulation. I view that as
crisis management?
You know, something else. But when I think of regulation, I think of what's in the interest of consumers, you know, so they can make informed choices and so forth. But yes, there has to be some mechanism when bad things happen. How do you unwind something?
We talked about your relationship with the Fed as it concerns TARP specifically. Yes. How about the work that the Fed is doing in general? What's your assessment? Thumbs up, thumbs down? Think Ben Bernanke has done a good job?
Yeah, I think Ben has done a good job. I think a very good job.
Where do you think he should err? Should he err on the side of withdrawing the stimulus faster and leaving the United States economy in a position where perhaps it doesn't grow as fast as it might? Or worse, we slip back into negative growth? Or he leaves the stimulus in too long and we end up with either a greater acceleration of or more persistent inflation for a longer period of time?
Yeah, I don't like either of those. He should
Nobody
be
does.
right in between the two of those would be perfect.
And when has the Fed chairman timed anything perfectly?
Well, that's why, you know, he's the Fed chairman. I have a lot of confidence in Ben Bernanke.
It's anybody's guess when the financial crisis will finally end, when credit markets return to normal. When they do, John Stumpf says the business of banking will have changed forever.
Well, I don't know that it's more profitable or less profitable. I think that the industry clearly will consolidate. I'm not projecting or in any way suggesting that we're going to have a European style or Canadian style with 5 or 6 big banks have it. I think the dual banking system, I think we're going to have, you know, maybe 4 or 5 large, and we're going to have a whole bunch of small, depending on size. I think here's, and this is probably not profound, but I think it's accurate, the monolines. Those who do narrow things will be gone. I think, so people will do generally most things, everything, if you will.
Does Wells Fargo want to become one of those consolidators? Does it see itself as being one of the consolidators?
Well, I surely think we're going to be clearly a survivor, and we're going to really prosper in this new realm because we're so connected to customers, deepening relationships. In fact, everybody wants to play that game today. And it's a very difficult, it's easy to say, it's very difficult to do.
How big does Wells Fargo want to get in investment banking?
We want to start with customers. We want to help customers succeed financially. And what we found at Wachovia was a real strong skill set and around helping customers, corporate customers, issue debt, issue equity, value businesses. And since we now have a large balance sheet, the so-called flow business, as compared, I don't have much interest at all in structured businesses.
Prop trading, that kind of thing.
Those kind of things. But as it relates to serving customers, we like that a lot, and we expect to be the biggest in the world. Bigger is never a big issue for me. I want to become the best at what we can do, and I think there's a place for us to play.
But you believe that you can beat out the likes of J.P. Morgan, Goldman Sachs, Morgan Stanley, you name it, in getting to those customers that you already have?
We think where we can add value, where we know the company knows us. We have a big retail distribution system here through Wachovia Securities, which is now Wells Fargo Advisors, and we have some very skilled people in our investment banking group, and we can more than hold our own and add value to those customers.
The attitude that you appear to have taken is, trust me, you don't need to know any more about our business than the regulators oblige, and we choose to tell you, and you'll do better as an investor if you sort of keep quiet and get out of our way. Is that a fair characterization?
No, it's totally unfair. In fact, tomorrow I may be gone all day meeting with investors about our company. At the end of each quarter, We share in much detail what's going on in the company. We take lots of calls. We have lots of analysts coming through here. So I think we do a very, very good job in telling the story about what we are, what we're doing.
Quite a vision. A banking industry with fewer banks, yet one where revenue may come less easily, not more so. John Stumpf says there's only one way to thrive in that future, by doing exactly what Wells Fargo does now. Growing deposits, using the money to make good loans, and doing as much business as possible with every customer. For the record, I'm Eric Schatzker.